For instance, gold at $1 with $1 move equaling $100 may actually have a breadth of range of $7 to $8 in one day, so a $700 to $800 move. Whereas you look at corn or soybeans, which has a 1 cent move equal to $50, may actually move maybe 2 or 3 cents during the day. So each one you would apply different money management rules based on the amount of fluctuation on the daily volume. So in a gold contract, I may be more willing to go with a 5, 6, maybe even 7% loss ratio to allow for the daily movement of the market. Keep in mind, losses mount quickly in futures, while profits take a long time. It's always a constant feeling of watching a pot boil. And immediately when the losses start to mount, they seem like they come rapidly, like waterfalls cascading down on you. And you have to be knowledgeable and emotionally willing to get out of a trade. Believe that no market is going to come back, and you'll be more than ready to get out of trades that are losing trades. Rules for winning trades. Well, you say, you know, why should I have rules for winning trades? I have one goal in mind. I want to make money. Well, that's a halfway decent goal, but it's good to go in with a specific amount that you're willing to take from the markets, because if you don't, you end up giving it all back. Targets in futures trading are very important. Typically, I base my targets on high levels of support and resistance and the effects of those, and I'll talk about that more in the second half of this trading program. But you have to have targets when you trade futures so that you know at every level how you're going to make your money and at where to put your next stop loss. Because as you accumulate profits, you don't want to leave them open-ended to give back. So you set targets. How we develop short-range targets, mid-range targets, and long-range targets are simply based on the daily, the weekly, and the monthly charts. The daily charts affect what the near-term or daily resistance is. The mid-range or weekly charts show what the mid-range targets are. And then the monthly chart shows where the all-time highs and all-time lows for these contracts are. So you look at those in order to determine each set target for your investment and how it develops. Sometimes things just don't work your way, and that's why we have the rules for losing trades. Plan your trade accordingly. Do not invest without knowing where you're going to get out. If you don't, you will definitely give back profits to the market. That's the worst thing and the worst feeling you could ever have. Scratch trades will happen. And what I mean by scratch trades are sometimes you'll get into a market that just is not going anywhere. Unlike many other investments, futures trading, you will find a lot of narrow range trading. These are real world goods. So the prices cannot be inflated excessively or decreased excessively without having an actual effect at the grocery store. So when you trade futures, you have to be very careful in commodities. You have to be very careful to pay attention that you don't get caught in a channel of trading. But sometimes it happens where you find yourself being whipsawed between a $5 range or a $10 range, and so every day you're either up $1 or you're down $2 and then you're back up $3. Trust me, get out of the trade. It's what I consider a scratch trade. If you can pull in a couple dollars or a couple bucks to cover your commission, fine. If you can't, and your maximum loss of your commission, fine. Just get out of scratch trades. If a trade doesn't develop within the time frame that you've set according to your plan, there's no point in staying in it. Typically, it's going to actually break, and if it breaks, it most likely will break against you. Definitely Murphy's Law. So get out of the trade, assess how the trade went wrong or why it went wrong, and maybe you're in too early, and then let the trade prove itself before you get in again. Don't jump in and out of trades. Very, very important, because the leverage allows you that kind of, or affords you that kind of opportunity. And in conclusion, futures investing is very risky. It's not for everyone. But for those people who've understood what I've said today and have understood the fundamentals, understood that people in the 15th century and the 16th century understood futures, realized that futures is not some Hightower investment. This is an investment of the people. People have invested in futures for centuries, and they'll continue to invest in futures. And with futures growing in leaps and bounds, you look at different ways for you to participate. And hopefully, with our explanation of the fundamentals of futures, along with our introduction to the new single stock futures and showing how it may affect your stock trading, as well as the top 10 mistakes that futures investors make, I've given you some insight, some nice bite-sized chunks to impart that when you decide to invest in futures, you have some ammo. Thank you very much for listening and watching this tape. We appreciate all your support here at Liverpool Derivatives Group. Much of the information that you've seen today is on liverpoolgroup.com, and you'll find a free newsletter that you can subscribe to on our website, along with real-time price charts and quotes. Once again, thank you very much, and I thank Pristine.com for giving me the opportunity to speak to you. Have a great day.